Here is a number that should concern you. Since 2021, the purchasing power of 10,000 sitting in a typical UK current account has fallen by over 2,000 in real terms. You didn't spend it. You didn't lose it on bad investments. It just quietly disappeared, eroded by inflation while it sat there doing nothing. And here's the problem. Most people think that chapter is over. Inflation peaked, it came down, crisis averted. But the data tells a different story. Oil prices have surged past $100 a barrel. The Bank of England has put rate cuts on hold. And UK CPI, which was supposed to be back at target by now, is still running above 3% and heading higher. In this video, we're going to look at exactly what's happening, why your savings and mortgage are both exposed right now, and what, practically speaking, you can do about it. No generic advice, just the data, the context, and the options. Before we go further, subscribe and hit the bell. I break down economics and finance every week in a way that actually makes sense. Let's continue. Before we get into what you can actually do, we need to understand what we're dealing with, because this inflation wave is structurally different from the last one, and that difference matters for how you respond to it. Inflation, at its core, is the rate at which the general price level of goods and services rises over time. When inflation is at 2%, the Bank of England's target, prices are rising slowly and predictably. Wages tend to keep up. Savings products can stay ahead of it. It's manageable. When inflation runs significantly above that target, the real value of your money falls, whether it's sitting in a savings account, invested in a pension, or simply in your current account. In 2022, most of you will remember it, inflation hit 11.1%, a 40-year high. The causes were a combination of post-pandemic supply chain chaos, surging consumer demand, and Russia's invasion of Ukraine driving up energy prices globally. It was a multi-factor crisis, and it took 2 years and a series of aggressive interest rate hikes to bring it down. By early 2026, it looked like the job was done. CPI had fallen back to 3%. The Bank of England had begun cutting rates. The expectation, from the bank itself, from the OBR, from most independent forecasters, was that inflation would hit the 2% target by spring 2026. The cost of living crisis appeared to be over. Then, on the 28th of February 2026, military strikes began against Iran. Iran responded by closing the Strait of Hormuz, a narrow stretch of water between Iran and Oman, through which approximately 20% of the world's oil supply passes every single day. Brent crude oil rose from around $70 a barrel before the conflict to peaks of over $100 a barrel within weeks. And because energy is an input cost for almost everything, manufacturing, food production, transportation, logistics, those higher prices don't stay at the petrol station, they move through the entire economy. Here is the key distinction from 2022 that you need to understand. The 2022 inflation was partly a demand shock, too much money chasing too few goods. The Bank of England could address that by raising rates. This inflation is a supply shock, a physical disruption to global energy. You cannot raise interest rates to reopen the Strait of Hormuz. So that's the macro picture. Now let's make it personal. Inflation doesn't just affect the economy in the abstract. It attacks your money through 3 very specific channels simultaneously. Channel 1. Your mortgage. If you're on a fixed-rate deal, you may feel insulated from this right now, but here is the number you need to pay attention to. Around 1.3 million additional UK households are now facing a jump in their mortgage payments by the end of 2028 as a result of the conflict, bringing the total number of households facing higher mortgage costs to 5.2 million. The average 2-year fixed mortgage rate was 4.83% in early March. By April, it had jumped to 5.90%, the highest level since July 2024. For a borrower with a $200,000 mortgage over 25 years, that shift translates to roughly $90 more per month, close to $1,000 more per year. And here is the mechanism most people don't fully understand. UK government bond yields, gilts, have climbed sharply as investors revised up their inflation expectations. Because gilt yields act as a benchmark for borrowing costs across the financial system, rising yields push up commercial banks' funding costs, which are then passed directly onto mortgage customers. The 10-year gilt yield has now hit 5.0%, its highest level since the 2008 financial crisis. This is why mortgage rates moved so quickly and so sharply. It wasn't just one decision from one committee, it was the entire bond market repricing simultaneously. Channel 2. Your savings. This is where it gets quietly painful, because the damage here is invisible. There's no letter from your bank telling you that your savings just lost value. It just happens. The average UK adult holds just over £19,000 in savings. Research shows that the average UK savings account has lost nearly £3,000 in real terms between 2020 and 2025. Not because the money was spent or lost, but because savings rates consistently failed to keep pace with inflation. Here's where it stands right now. The average instant access savings rate in the UK is 2.12%. UK CPI is 3.3% and heading higher. That gap, over 1 percentage point, is the silent annual loss on every pound sitting in a standard easy access account. Channel 3. Your everyday costs. This one you're already feeling, but the data puts it into sharper focus. The cost of living accelerated throughout March, with petrol and diesel prices posting an 8.7% monthly jump, the sharpest single-month rise since summer 2022, when Russia invaded Ukraine. The average liter of petrol rose by nearly 25 pence in a matter of weeks. Gas accounts for 62% of final household energy consumption in the UK, by far the highest share in the G7, and UK electricity prices are closely tied to wholesale gas. The UK also imports around 44% of its energy, making it more vulnerable to global price shocks than more energy self-sufficient economies. That 62% figure is the one that matters most for your household budget. So to summarize where we are, if you have a mortgage coming off a fixed rate in the next 12 to 18 months, you are facing materially higher repayments than you planned for. If your savings are in a standard easy access account, they are losing real value every month, and your grocery and energy bills are going to keep rising before they stabilize. That is the environment. Now let's talk about what you can actually do about it. Before we go through these, one important framing note. What follows is general financial education, not personalized financial advice. Everyone's situation is different. If you're making significant financial decisions, speaking to a regulated, independent financial advisor is always worth considering. Option 1. Your savings account is probably working against you, and switching takes 15 minutes. The average instant access savings rate in the UK is currently 2.12% against a CPI rate of 3.3%. The good news is the top end of the market is significantly better. The best instant access rate currently available without restrictions is 4.27%, above the current CPI rate. On £20,000 of savings, the difference between 2.12% and 4.27% is over £400 a year after doing nothing except opening a different account. Also worth noting, your £20,000 ISA allowance has reset for the 2026-27 tax year. Filling it with a competitive rate cash ISA first is generally considered the most tax-efficient approach for most savers. And always check your FSCS protection. The scheme covers up to £120,000 per banking license, not per brand name. Option 2. If your fixed-rate mortgage is ending within 12 months, the window to act is now. Most UK mortgage lenders allow you to lock in a rate up to 6 months before your current deal ends, without paying any early repayment charge. With market rates shifting daily, over 1,500 mortgage products have been withdrawn since the conflict began. Waiting passively is a meaningful decision in itself. Oxford Economics has outlined 3 scenarios. Best case, rates retreat toward 4.5%. Base case, rates stabilize around 5.0 to 5.5%. Worst case, rates could move higher still. Quick pause. Subscribe, like, and share this with one person who needs to know this. Done? Good. Let's continue. Option 3. Gilts, the government bond most people have never considered. A gilt is a bond issued by the UK government. You lend money to HM Treasury, they pay you interest twice a year, the coupon, and return your capital at the end of the term. The UK government has never defaulted on a gilt in 3 centuries of continuous payments, and with 10-year gilt yields now at 5%, their highest since 2008, the income available from this option is at a generational high. There are 2 types worth knowing: Conventional gilts pay a fixed coupon, and gains are free from capital gains tax. Index-linked gilts adjust both the principal and interest payments in line with inflation, meaning their returns are not eroded by rising prices. The practical route for most retail investors is to buy short to medium-dated gilts through established investment platforms, and to use an ISA allowance to shelter coupon income where possible. Option 4. Concentration in cash is itself a risk, and equities have historically outpaced inflation over the long run. Over the very short term, equity markets face real headwinds, but the relevant question for a 40-year-old is not what markets do over the next 6 months, it's what they do over the next 15 to 20 years. Historically, a diversified portfolio of equities has outpaced inflation over rolling 10 and 20-year periods in the UK. Companies can raise their prices in response to inflation, passing costs on to consumers and protecting their real revenues. Cash in a current account cannot do that. Option 5. Your household costs, the one area where small, deliberate actions compound quickly. Household gas bills are expected to increase in July 2026 as the energy price cap adjusts. Locking in a fixed-rate energy tariff now, if your supplier offers one at an attractive rate, could insulate your bills from further increases. Reviewing your current tariff against market comparisons now, before the July cap change, costs nothing. None of these actions individually changes the macroeconomic picture, but collectively, a better savings rate, a deliberate mortgage decision, a tax-efficient wrapper, and a reviewed energy tariff, they represent the difference between being a passive recipient of an inflationary environment and someone who has engaged with it deliberately. That is the point of this video. Everything we've covered so far is context. This section is about converting that context into deliberate action, not panic, not guesswork, but 4 specific low-effort things that are directly relevant to the next 7 days. This Thursday, watch the Bank of England decision and listen to what they say, not just what they do. The Bank of England's Monetary Policy Committee announces its next interest rate decision this Thursday, 30th April 2026, at 12 noon. Listen for 2 things: how they describe the inflation outlook, temporary or persistent, and whether any members vote for a rate hike. Even a single dissenting vote in that direction would be a significant signal. Action 1. Check what rate your savings are actually earning today, not approximately. Exactly. Log into your savings account this week and find the current interest rate. Then go to MoneyFacts or Money Saving Expert and find the best easy access rate currently available. The top instant access rate without restrictions is currently 4.27%, well above the average of 2.12%. On £20,000, the difference is over £400 a year. Action 2. If you have a mortgage, find out your exact end date, not roughly. Find the paperwork, log into your lender's portal, or call them and confirm the exact month your current deal expires. If that date is within the next 12 months, you are inside the window where lenders will typically allow you to secure a new rate now without penalty. Action 3. If you haven't used any of your 2026-27 ISA allowance yet, the clock is running. The new tax year started on 6th April. Your £20,000 ISA allowance is fresh. Every week that passes where savings sit in a taxable account rather than an ISA wrapper is a week of interest being unnecessarily exposed to income tax. 4 actions. Watch Thursday's MPC decision and read the summary. Check your exact savings rate and compare it to the market. Find your mortgage end date if you have one, and review your ISA position for this tax year. None of these require a financial advisor, a complex decision, or any significant time. They require awareness, and that's exactly what this channel is here to provide. The people who navigate inflationary periods well are rarely the ones who predicted them earliest or reacted fastest. They're the ones who understood what was actually happening, ignored the noise, and made a small number of deliberate, informed decisions. The Bank of England has said clearly, monetary policy cannot affect global energy prices. But how we adjust to them is within our control. That adjustment, at the household level, starts with understanding, which is what you now have. Let's bring everything together quickly. Inflation in the UK is not a repeat of 2022. That was a demand shock. This is a supply shock, a physical disruption to global energy markets. The Bank of England has said explicitly that monetary policy cannot fix global energy prices. The impact is landing in 3 places simultaneously: mortgage rates up, savings losing real value, energy and food costs rising. The 4 things worth doing this week are simple. Watch Thursday's Bank of England decision, check your exact savings rate, find your mortgage end date, and review your ISA position. None of those actions require taking risk. They require awareness. Everything in this video is general financial education and economic analysis. It is not personalized financial advice, and it should not be treated as such. Everyone's financial situation is different. If you are making significant financial decisions, speaking to a regulated independent financial advisor is worth considering. Simply FinCon is here to make sure you understand the economic landscape clearly. What you do with that understanding is your decision. If this video gave you something useful, subscribe. New videos every week. No noise, no hype, just the economics and the context that actually matter to your money. And drop your topic suggestions in the comments. That's where the next video comes from. Thanks for watching Simply FinCon.